You are about to hear one number that will permanently change the way you look at $500. Not because $500 is a lot of money. For most adults, it barely survives a week. Rent takes some of it. Insurance takes some. Groceries take some. The credit card carrying a balance quietly takes the rest. The money enters your account already assigned to something else. Nothing dramatic happens. No emergency. No financial disaster. It simply disappears through normal life. But imagine that one month, instead of allowing all $500 to disappear, you redirect it. Not into a secret investment, not into a risky cryptocurrency, not into a business requiring employees, inventory, and 12-hour days. You place it into a diversified investment and repeat the same decision every month. Then you leave it there for 30 years. Using a hypothetical 7% annual return compounded monthly, that $500 monthly habit grows to approximately $609,985. You contributed $180,000. The remaining $429,985 came from hypothetical investment growth. This is only an illustration, not a promise. Markets rise and fall, fees reduce returns, taxes may apply, and no investment guarantees a 7% return. Investor Gov's compound interest calculator uses the same basic inputs: monthly contribution, time, estimated return, and compounding frequency to demonstrate how money may grow over time. This story begins with $500, but it is really about time. Month 1, it begins on an ordinary Tuesday. You open a brokerage account. Not because you suddenly became an investment expert. Not because you studied every fund available. You open it because you finally understand that waiting also has a price. The price does not appear on a receipt. It does not arrive as a bill. It appears years later as the difference between what you built and what you could have built. You decide to split the $500. $300 goes into a Roth IRA, assuming you qualify. $200 goes into a standard brokerage account. That is $3,600 per year going into the Roth IRA, below the 2026 total IRA contribution limit of $7,500 for most eligible individuals. Roth eligibility also depends on income and taxable compensation. Inside both accounts, you choose a low-cost, broad market index fund. An index fund is a mutual fund, or ETF, designed to track a market index. A broad fund can spread your money across many companies, although diversification reduces risk rather than eliminating it. You schedule the transfer. $500 every month, same date, same amount, no decision required. This is called dollar cost averaging, investing equal amounts at regular intervals regardless of whether the market is rising or falling. Then you perform the hardest part of the entire strategy. You leave it alone. For the first few weeks, your brain keeps asking questions. What if the market drops? What if you chose the wrong fund? What if a better opportunity appears next month? What if you should wait until prices are lower? The doubt feels intelligent. It feels like research. But sometimes research is simply fear wearing glasses. There will never be a morning when the market sends you a notification saying everything is safe now. This is the perfect time. The transfer happens anyway. That is the system. Everything after this is simply what happens when you stop interrupting it. Year 1, 3 months later, the account holds approximately $1,120. You deposited $1,500. The growth is barely visible. It looks like nothing. That is where most people become disappointed. They imagined that investing would feel powerful. Instead, it feels like moving money from one app to another. The account rises one week, then falls the next. After months of discipline, the gain may be smaller than the amount you spend eating out once. The human brain likes fast feedback. You exercise and want to see the weight change. You post a video and check the views. You work and receive a paycheck. But investing operates on delayed feedback. The result arrives long after the behavior that created it. That delay is where many financial futures quietly die. Not because the plan failed, because the plan did not become exciting quickly enough. At the end of year one, the account holds approximately $6,196. You contributed $6,000. The hypothetical growth added only about $196. That number is not impressive, but the balance is not the biggest thing you built during year one. The habit is, 12 months ago, you believed every dollar of your income was essential. Now you have lived an entire year on $500 less each month. You adjusted. You canceled subscriptions you forgot you had. You cooked a little more. You stopped buying things simply because the payment looked small. The lifestyle moved around the investment. That adjustment is more valuable than the first $196 of growth. The account can recover from a bad year, but the habit of paying your future before spending on your present has to be constructed 1 month at a time. Year 3, at the end of year 3, the account holds approximately $19,965. You contributed $18,000. The growth added approximately $1,965. Something changes when you see almost $20,000. It no longer feels like money you temporarily moved. It begins to feel like something you own. A small machine, still weak, still dependent on your contributions, but working. At a hypothetical 7%, a balance near $20,000 may produce roughly $1,400 in growth during an average year. You are still contributing $6,000 annually. Your labor is still doing most of the work, but the ratio is beginning to move. Every year, you add the same $6,000. Every year, the balance becomes larger, and every year, 7% of that larger balance becomes a larger number. Your contribution stays flat. The potential growth expands. The finish line is not waiting for you. It is slowly moving toward you. And then another question appears. What would have happened to those 36 separate $500 payments if you had not invested them? One became a weekend trip. One became clothing you rarely wear. One became upgrades added to a car loan. One became food delivered to your door because cooking felt inconvenient. None of those purchases felt irresponsible at the time. That is what makes ordinary spending dangerous. It does not destroy you dramatically. It simply leaves no evidence that the money was ever there. The money spent has no remaining value. The money invested has a history. But before we move to year 5, there is a leak in this story that needs to be addressed. The credit card leak imagined that your investment is hypothetically earning 7%, but you were carrying credit card debt charging 20%, 25%, or more. One account is growing, the other is bleeding faster. You feel productive because you were investing $500, but the interest on your debt may be quietly reversing the progress. Investor, Gov says eliminating high-interest debt generally provides a better and less risky financial benefit than attempting to earn investment returns while carrying that debt. This does not always mean you must stop every retirement contribution immediately. An employer match, emergency savings, taxes, and your personal situation matter. But it does mean you need to understand the math. Do not celebrate earning a hypothetical 7% while ignoring debt charging 3 times as much. This is also where credit repair enters the strategy, not fake credit repair. Not disputing every negative account and hoping something disappears. Real credit repair begins by checking whether the information in your reports is accurate. Pull your reports from Experian, TransUnion, and Equifax. Check for accounts that do not belong to you. Closed accounts reported as open. Incorrect late payments, wrong balances, duplicate collections, incorrect limits. wrong dates, and debts appearing more than once. The CFPB says consumers have the right to dispute inaccurate or incomplete information with both the credit reporting company and the business that supplied it. Accurate and current negative information generally cannot simply be removed because it is inconvenient. Fix genuine reporting problems. Lower high card balances. Stop applying for accounts you do not need. Pay every bill on time. Because wealth is not only about how much your investments earn, it is also about how much interest and bad credits stop taking away. Then the $500 system continues. Year 5, at the end of year 5, the account holds approximately $30,796. You contributed $30,000. Hypothetical growth added approximately $5,796. The number is becoming real now. It could cover a serious emergency. It could represent part of a future down payment. It could keep you alive financially during a job loss. But you do not touch it, because the purpose of this account was never to solve every current desire. Its job is to remain invested long enough for time to become useful. During year 4, the market falls, not a tiny decline. The type of decline that fills television screens with red arrows. Your balance drops by thousands. Money that took years to build appears to disappear in weeks. You open the app too often. You calculate what remains. You wonder whether you should sell now and buy again after everything becomes safer. That thought feels reasonable. But you do not know when the decline ends. You do not know when the recovery begins. Selling requires 2 correct decisions: when to leave and when to return. So the automatic transfer continues. $500 enters while prices are lower. You purchase more shares with the same contribution. Some months feel uncomfortable, but regular investing means the amount continues regardless of market direction. It does not prevent losses or guarantee profit, but it removes the need to make a new emotional decision every month. The account is no longer only savings, it is infrastructure. You now understand something the version of you from month 1 could not understand. Financial confidence does not come from knowing the market will never fall. It comes from having a plan designed for the fact that it will. Year 10, at the end of year 10, the account holds approximately $86,542. You contributed $60,000. Hypothetical growth added approximately $26,542. The account is approaching $100,000, and something mathematically important is happening. At a hypothetical 7%, $86,542 represents roughly $6,058 of potential growth in an average year. Your annual contribution is $6,000. For the first time, the existing balance may produce about as much as you personally contribute. This is the crossover point. For 10 years, you push the account forward. Now the account begins pushing beside you. You still send the $500. You do not stop. But your new contributions are no longer the only serious force inside the account. The money already there has enough weight to create visible movement. And while the investment account changed, something else may have changed during those 10 years. Your credit profile. 120 months have passed. If you paid on time, kept revolving balances controlled, avoided unnecessary applications, and corrected genuine reporting errors. The person applying for credit today looks completely different from the person who started. The old version of you may have accepted any car loan that received an approval. The current version arrives with a pre-approval and asks the dealership to beat it. The old version carried high card balances because there was no emergency fund. The current version has savings and does not need to turn every surprise into revolving debt. The investment account is not what fixed the credit. The system behind it did. Planning ahead. automating good decisions, reducing expensive debt, protecting payment history, and allowing time to work. Now, you perform another calculation. You began at age 25. What happens if another person waits until age 30 and then follows the exact same plan until age 55? Same $500, same hypothetical 7%, same discipline. You invest for 30 years and reach approximately $609,985. They invest for 25 years and reach approximately $405,036. The difference is approximately $204,950. 5 years of delay did not cost $30,000. That was only the amount of missed contributions. The larger cost was the growth those early contributions never received. Nobody sends an invoice for waiting. That is why delay feels free. It is not. Year 15, at the end of year 15, the account holds approximately $158,481. You contributed $90,000. Hypothetical growth added approximately $68,481. The gap between what you deposited and what the account holds is widening. In the early years, almost everything came from you. Now more than $68,000 exists that was never part of a paycheck you deposited. It came from the assumed growth of the money already invested, and growth on previous growth. The account does not feel exciting the way you imagined. It feels quiet. Most months, you barely check it. The transfers happen. The purchases happen. Dividends may be reinvested. The system continues without requiring motivation. That is exactly why it works. Anything requiring you to feel inspired every month will eventually stop. Your mood changes. Your schedule changes. Your income changes. Your responsibilities change. Automation does not care. The transfer happens whether you feel ambitious or tired. A coworker asks how the investing is going. You tell them the balance. They pause. Then they say, "I've been meaning to start." You do not lecture them. You remember what month one felt like. You remember how small the first gains appeared. You understand why they waited. But you also understand what they do not. Meaning to start is not a neutral position. Every year spent meaning to start becomes one less year available for compounding. Year 20, at the end of year 20, the account holds approximately $260,463. You contributed $120,000. Hypothetical growth added approximately $140,463. The growth has now contributed more than you did. That is the inversion most people cannot imagine when looking at their first $500 transfer. At the beginning, your money needed you. Now the account contains enough capital that its movement can become larger than your salary contribution. At a hypothetical 7%, a $260,463 balance represents about $18,232 of potential annual growth in an average year. That is more than 3 times your $6,000 annual contribution. Again, no individual year is guaranteed to return 7%. One year may rise much more, another may fall, but the projection demonstrates what becomes possible when a growing balance receives decades instead of months. Your city enters a difficult economy. Businesses close, layoffs begin. People around you become nervous. You are nervous too. An investment account does not make you immune to reality. But fear feels different when a foundation exists underneath you. You are no longer facing uncertainty with nothing. The account does not solve every problem, but it creates distance between a bad month and financial destruction. The original $500 never increased. Your income may have risen over the years. Inflation changed what $500 could buy. But you never canceled the system because it had already become part of your identity. You did not invest whatever happened to remain at the end of the month. You invested first. Then the month was built around what remained. Year 30, at the end of year 30, the account holds approximately $609,985. You contributed $180,000. Hypothetical growth added approximately $429,985. You are now 55. The entire account began with one automatic transfer on one ordinary Tuesday. Nothing about that day felt historic. You did not feel different when you went to bed. There was no celebration. No one congratulated you. But the decision continued repeating after the emotion disappeared. That repetition created more than $500,000 in this hypothetical example. And this may not be the only asset you have. You may have a workplace retirement account, home equity, emergency savings, a business, other investments. The $500 account is only one part of the full picture, but it may be the part with the longest runway. And the longest runway usually gives compounding the most time to become visible. You think about the version of yourself who never started, not as a failure, not as someone lazy, just someone who made a timing decision without understanding that it was a timing decision. That person still spent the $500. Month after month, the money still left the account. It simply went somewhere that could not return anything later. Your version sent the money into a system. One earned comfort for a moment. The other purchased time. Somewhere tonight, someone is looking at their banking app. There is $500 sitting there that has not been assigned yet. It is not extra money. Nothing feels extra when you are an adult. Within days, something will claim it. A meal, a payment plan, a weekend, an upgrade, a purchase that will feel completely reasonable. The $500 itself is not the most important part. The direction is. One decision sends it towards something temporary. The other sends it toward a future that does not exist yet. And that person may believe they are deciding what to do with $500. They are not. In this hypothetical projection, they are deciding whether that monthly habit gets the opportunity to become approximately $609,985. But remember the full lesson. Do not invest while ignoring high-interest debt that is growing faster. Do not build a portfolio while allowing inaccurate credit information to make every loan more expensive. Do not chase returns without emergency savings. Do not buy investments you do not understand. Do not assume a hypothetical 7% is guaranteed. Start with the foundation. Review the credit reports. Correct genuine inaccuracies. Pay down high-interest balances. Protect every payment. Build an emergency reserve. Then automate an amount you can sustain. Maybe it is not $500 yet. Maybe it is $50. Maybe it is $100. The first amount matters less than the system. Because the goal is not to perform one impressive financial act. The goal is to create one ordinary decision that keeps happening long after it stops feeling impressive. $500. Every month. 30 years. You supplied $180,000. Time did the remaining work. And time is the only part of this equation you cannot earn back.